Welcome to Talk Tickers, your deep dive into the latest earnings calls and market insights.
Great to be here.
Today, we're digging into ABM Industries' Q3 2025 results and, well, their strategic path forward.
Yeah, it was a really interesting quarter, kind of a mixed bag for investors,
Absolutely. You had this strong top-line growth, really impressive cash generation, too.
Right, but then these unexpected margin pressures hit, and that definitely caught the market's attention.
So we're going to unpack what really drove these results and, importantly, what ABM is signaling for the future.
It's a good example, isn't it? How sometimes the headline numbers, they just don't tell the full story. The market reacts to maybe one thing, but when you look deeper, ABM's strategy, their operational moves, it paints a much richer picture.
Okay, so let's cut right to the core of ABM's Q3 then. Adjusted EPS, it came in at 32 cents.
Yeah, and that missed the consensus. I think it was 95.
That's right, missed by $0.13. So yeah, a pretty significant miss on the bottom line there.
The revenue side, totally different story.
Exactly. Revenue surged to $2.22 billion.
Which beat estimates, right? Consensus was around $2.15 billion.
Yep, beat it by a good margin. And that's a solid 6.2% year-over-year increase.
And the organic piece was strong too, 5.0%.
Really strong. So that revenue picture looked good.
Indeed. And adjusted EBITDA, that also grew about 5% year over year, hitting $125.8 million.
Keeping the margin steady around 5.9%.
Right. But the thing that genuinely really stood out was the cash flow.
Oh, yeah. That was incredible.
Free cash flow surged, 134% year over year to $150.2 million.
And operating cash flow up 120% to $175 million. I mean, that's a powerful statement about their, efficiency.
Huge numbers. Definitely shows they're managing operations well on that front.
That cash flow performance is, truly exceptional. And beyond the core numbers, they showed strength in new business, too.
Bookings were up.
Year-to-date bookings passed $1.5 billion. That's a 15% jump year over year.
Okay, so demand is still there.
Seems like it. And they're showing confidence,
Yes.
right? Kept the dividend the same, 0.265 per share.
And they boosted the share repurchase authorization.
By another $150 million. Yeah.
So despite that strong top line, that amazing cash flow, the market's first reaction was, cautious.
Focus squarely on that EPS miss.
And the revised guidance, led to a noticeable dip in the share price, pre-market anyway.
So that contrasts, strong underlying business versus cautious market, that's what we really need to dig into.
Absolutely. Let's get into those details.
Okay, so diving deeper, that 5.0% organic revenue growth you mentioned, turns out it's actually their highest since way back in Q4 2022.
Wow, okay.
And every single business segment contributed positively. So it wasn't just one area carrying the load.
That suggests pretty broad-based health then, even with some of the other issues.
Right, but then connecting that back to the adjusted net income, it dipped slightly, didn't it, from 0.84 cents last year?
$2.82 per share, yeah. But the key reason wasn't, a fundamental operational problem in their service delivery.
Okay, so what was it then?
It mainly came down to higher interest and tax expenses this quarter.
Ah, okay. So less of an operational hiccup causing the EPS miss, more financial factors.
Exactly. Interest expense was $25.3 million for the quarter. That was up $4.1 million from last year.
And higher than expected.
A bit higher, yeah. Partly because cash collections were apparently really weighted towards the end of the quarter.
Timing issue.
Right. Now, their total debt is $1.6 billion, which sounds like a lot, but
they have liquidity.
Plenty. $691 million available. Keeps their debt to EBITDA ratio manageable at 2.8 times. So, higher interest was a drag, but it wasn't like a liquidity crisis or anything.
Okay, that context definitely helps clarify things. So let's break down the segments now. How did each one perform? And how are they managing these margin dynamics strategically? Who led the charge this quarter?
Technical Solutions, ATS.
Okay.
That segment really spearheaded the growth. Revenue up 19%.
19%.
Yep, break that down. 7% was organic, 12% came from an acquisition.
Still, 7% organic is strong. What drove that?
Big demand for microgrids, data centers, power services, stuff like that. That area now makes up almost 60% of the ATS revenue.
Okay. And profit?
Operating profit was up 9%, but the margin actually dipped slightly. 7.8% from 8.5% last year.
Why the dip?
Mostly business mix, plus some higher amortization costs. But importantly, ATS is usually a powerhouse in Q4.
Right. Seasonally strong.
Very strong. So they expect a good finish to the year there.
Got it. Okay, moving to aviation. How did that look?
Solid. 9% revenue growth. Clearly benefiting from, air travel staying resilient.
Yeah, those TSA numbers were high in July and August.
Exactly. Over 2.88 million daily screenings on average, and operating profit there was up 11%.
Did margins improve?
They did, actually. Boosted margins by 20 basis points to 6.8%. So just a strong, stable performance from aviation.
Okay. Now, what's fascinating is how they're making some strategic choices elsewhere, maybe sacrificing a bit of margin now for later.
Right. Take manufacturing distribution, M&D. Revenue there was up 8%.
Driven by new contracts. New contracts and expansions, yeah. Especially in tech, they mention landing deals with major U.S. and Asian semiconductor manufacturers, even a big capacitor maker.
Okay, good wins. But I noticed the margin in M&D took a pretty big hit. What happened there?
You're right to spot that. Operating profit margin dropped quite a bit, actually, from 10.9% last year down to 8.9%.
Ouch. Why?
It was apparently a deliberate decision. They strategically priced some bids, roughly 100 basis points below their normal minimums.
To get into new markets.
Exactly. Specifically, to gain entry into these new high-growth areas like the semiconductor supply chain. It's a long-term play, basically.
Secure future growth, except a temporary margin dip now.
Precisely. It's a strategic trade-off.
Okay, this next bit is really insightful, I think, because it shows their defensive moves. Business and industry, or B&I, revenue grew 3%.
Supported by escalations, expansions with current clients.
And strength in the UK, plus sports and entertainment.
Right. But we know certain commercial office markets are still, well, struggling.
Yeah, particularly some on the West Coast, Midwest, Mid-Atlantic. Those metro areas are recovering slower. So how did ABM handle that?
Well, this gets to how companies protect market share, protect relationships in tough sectors, right? ABM's pricing in B&I got more defensive. The goal wasn't maximizing margin short term, it was protecting their client footprint.
Keeping those long-term marquee clients.
Exactly. Through renegotiations, sometimes that meant reducing the scope of work or maybe adjusting the timing of price escalations.
Did they give examples?
Yeah, they mentioned one large multi-building office client in the Northeast where they reduced scope, adjusted escalations, but secured a long-term extension. And another similar move in downtown LA to proactively keep a key client relationship. It's about preserving that long-term value.
Makes sense. Playing the long game again. And then education. How did that fare?
Education was actually a real bright spot. Revenue up 3%, benefiting from stability in higher ed and K-12.
And the profit.
That's the impressive part.
Yeah.
Operating profit grew a robust 17%.
17%. Wow. And margins.
Margins expanded nicely, up 110 basis points to 9%.
What drove that?
Mainly better labor efficiencies and getting those price escalations through.
Okay. So given all these mixed pressures across the segments, ABM acknowledged the Q3 margin issues came from, what, a bunch of things hitting at once?
Yeah, basically an aggregation. Concurrent episodic pricing renegotiations like in B&I, plus those strategic new business bids like in M&D, it all hit the same quarter.
So what are they doing about it?
To tackle it head on, they launched a company-wide restructuring program back in August.
You mean for savings?
Targeting at least $35 million in annualized run rate savings.
Okay, that's significant. When do we see the impact?
They expect about $10 million in charges for it in Q4, but the full run rate savings, that $35 million, should be realized by the start of fiscal year 2026.
So clear, proactive measures underway.
Absolutely. Along with focusing on labor efficiency and keeping a tight lid on discretionary costs across the board.
Right. So they're taking direct action on those margin concerns, which is, critical. Speaking of action, let's talk cash flow discipline and capital allocation again.
Yeah, the cash collections were impressive.
They described it as laser-focused. And it showed, right, a 7% sequential drop in days sales outstanding, DSOs, from Q2 to Q3.
That's a big move. Really shows those post-ERP migration improvements are paying off. Testament to good financial management.
Totally. And their capital allocation, it really screams confidence in that cash generation, doesn't it?
Definitely. The share buybacks continued.
Yeah, 555,000 shares bought in Q3 for $27.1 million.
And they bought more after the quarter ended, too.
Another 491,000 shares for $23 million. So year to date, that's about 1.5 million shares repurchased.
For around $71 million total cost.
And then the board approved increasing the repurchase authorization.
By $150 million.
Yep. Brings the total current capacity up to $233 million. That sends a pretty clear signal, I think.
Yeah. Management clearly believes in the company's cash generation and, well, its stock value.
So shifting gears slightly, how does ABM fit into the bigger picture? the macro trends, AI? What are the tailwinds and headwinds they're facing?
Well, on the plus side, the tailwinds, you've got steady demand for outsourced facility services generally.
Aviation's still healthy, driven by passengers and airports reinvesting.
Right. And those supportive end markets for ATS and M&D, we talk about semiconductors, e-commerce build-outs, those are still going strong.
And looking further out, things like the U.S. microgrid market.
Huge potential there, projected to more than double by 2030, driven by energy resilience, decarbonization needs.
Plus, global data center capacity keeps expanding double-digit pace, thanks to AI needing more computing power.
And don't forget the reshoring trend in U.S. manufacturing. Pharma, automotive, that's another big opportunity ABM can tap into.
Okay, so plenty of supportive trends. What about the headwinds?
Well, as we discussed with B&I, that slower recovery in certain U.S. office geographies is definitely a headwind.
Right, the non-prime markets.
Exactly. And of course, the impact of those higher interest and tax expenses hitting the bottom line.
So a mixed picture, for sure, but some powerful growth engines seem to be in play.
Definitely.
So what about AI integration? How are they approaching that?
They're actively investing. Using AI tools internally first, to enhance operations.
Like automating RFP responses?
RFP responses, improving HR support, things like that. But they're also looking beyond that, exploring more advanced stuff like agentic AI.
Agentic AI, explain that.
Basically, AI systems designed to act more autonomously towards specific goals. They're looking at using it for client-facing services, maybe finding new revenue streams, even helping with robotics deployment.
Interesting. So how does management see AI overall? Threat or opportunity?
They frame it as a significant tailwind, not a threat.
Why is that?
They emphasize that ABM's core services, cleaning, maintenance, engineering, these are fundamentally people-led.
Hands-on work.
Exactly. Dynamic, hands-on, not really prone to full automation by current AI. So they see AI more as a tool for efficiency, for enhancement, rather than something that's going to disrupt their core business model.
Makes sense. When do they expect AI to have a meaningful impact?
They're saying it'll likely ramp up from 2026 through 2028. So it's more of a medium-term benefit they're planning for.
Okay. A thoughtful approach to a big technology shift. Now, let's bring it back to the near term. What's the Q4 outlook? What are the catalysts for improvement they pointed to?
Well, management sounds pretty optimistic about Q4. They anticipate a material sequential improvement in both EPS and margin.
How much improvement?
They're talking about roughly 100 basis points of margin improvement from Q3 to Q4. That's a pretty strong forecast to end the year.
A significant step up. What's driving that expected jump?
The main driver is that seasonal strength we talked about in technical solutions, ATS. Historically, ATS hits operating profit margins of 11-13% in Q4.
Okay, so ATS carries a lot of the weight for Q4 margin expansion.
A big part of it, yeah. But they also expect moderate improvements in B&I and M&D margins.
From what?
Partly from the restructuring benefits starting to kick in. They expect about 20% of that $35 million annualized savings to hit in Q4.
Okay.
And also just the timing of some contract escalations finally flowing through.
Got it. So putting it all together for the full fiscal year 2025, where does that leave guidance?
Adjusted EPS is now expected toward the low end of the $3.65 to $3.80 range they previously gave.
Okay, tempering expectations there slightly.
Right.
And the EBITDA margin?
Targeting approximately 6.3% to 6.5% for the full year.
And they gave Q4 specifics on interest and cash flow needed.
Yeah, Q4 interest expense projected around $25 million, similar to Q3. And to hit the low end of their full-year free cash flow range, right, $250, $290 million, they'll need to generate about $140 million in free cash flow in Q4.
Which seems achievable given the Q3 performance, maybe.
Potentially, yeah. It's a high bar, but Q3 was $150 million, so it's in the realm of possibility. What's crucial, though, is management's confidence.
Confidence that Q3's issues won't repeat.
Exactly. They explicitly said the concurrent episodic margin pressures they saw in Q3 are not expected to recur in Q4. They even noted they haven't seen something like that happen in 20 years.
Implying Q3 was a temporary perfect storm and anomaly.
That seems to be their message, that it was an unusual aggregation of events.
Okay, that's definitely what investors will be watching closely in Q4 results. And thinking longer term, beyond Q4, what's the vision?
Well, getting the full run rate of those $35 million restructuring savings is key. That should be fully in place by the start of fiscal 2026.
So continued cost discipline.
Right. Ongoing strong bookings, which they highlighted, plus these aggressive cost actions. Those are the catalysts for repairing and expanding margins over time.
What about the office market recovery?
They see the recovery in prime office markets, especially the Class A properties, as a significant long-term tailwind.
And those contracts they renegotiated defensively in B&I.
The expectation is they can rework margins back up on those over time. Extensions are typically 2 to 5 years, giving them time to recover and potentially exceed initial margin levels eventually.
And layered on top of all that are the AI benefits.
Which, again, they see becoming meaningfully impactful from 2026 through 2028, enhancing efficiency, maybe opening up new revenue streams down the line.
So despite the Q3 bump, they've laid out a pretty clear path for recovery and growth.
Seems so. Which brings us, I think, to our not financial advice segment.
All right. Let's talk ABM trade ideas. Now, remember, everyone, it's purely hypothetical, just thinking through the dynamics, not actual financial advice.
Definitely not. Just batting ideas around based on the call.
Okay, so the market clearly dinged ABM for the Q3 margin squeeze and guiding to the low end.
Yep, the short-term reaction was negative.
Yeah. The company laid out, I think, a pretty compelling case for a Q4 turnaround, driven especially by ATS performance and those restructuring savings kicking in.
Right. So here's a thought for you, maybe a bit out there, but grounded in what they said.
Let's hear it.
How about a relative value play? Go long ABM, but short a basket of office REITs. Specifically, REITs heavily exposed to those non-prime secondary office markets.
Interesting. What's the rationale there?
Well, think about it. ABM's management explicitly called out certain commercial office markets, especially in select West Coast, Midwest, and Mid-Atlantic metro areas, as being under pressure.
Right, where they had to do those defensive pricing renegotiations.
Exactly. The fact that ABM, a service provider, felt the need to sacrifice short-term margin to protect long-term relationships with marquee clients in those specific markets, it strongly suggests the underlying fundamentals for the landlords, the REITs owning those buildings, are probably even worse than their current depressed valuations might indicate.
So ABM's defensive moves are a signal about the health of those specific office submarkets.
That's the idea. Conversely, while ABM faced short-term pressure from those negotiations, their core services are inherently sticky. They're locking in revenue with 4 or 5-year extensions on big contracts.
Plus, they're taking action internally, that $35 million restructuring.
And the benefit starts hitting this quarter, Q4. And don't forget ATS, that high-margin powerhouse expected to have a great Q4 with potentially 11-13% operating profit.
So the trade bets on ABM's ability to recover through operational agility and diversification.
While simultaneously capitalizing on the continued structural pain facing that less desirable office real estate, the very pain ABM is navigating defensively.
It's kind of contrarian on ABM's short-term sentiment,
but perfectly aligned with their long-term strategy and the bigger shifts happening in commercial real estate. It pits ABM's diversified model and cost actions against the pure play exposure of struggling office REITs.
Okay, definitely something to chew on. So wrapping up on ABM Industries, their third quarter really showed a company navigating some complex dynamics, but with what looks like a clear strategy.
Yeah, the adjusted EPS miss definitely grabbed attention, but you can't ignore the resilient revenue growth and that truly impressive free cash flow generation. It underscores the fundamental strength of the business model, I think.
And the strategic moves preserving those long-term client relationships, even at a short-term cost, combined with aggressive cost-cutting like the big restructuring.
Yeah.
It all points towards that anticipated Q4 rebound and hopefully a stronger fiscal 2026.
They seem to be actively adapting, right? Leveraging strength in high-growth areas like aviation and especially technical solutions, and embracing tech like AI as a long-term tailwind, not shying away from it.
So we'll definitely be watching to see if that promised Q4 margin inflection materializes and if the restructuring benefits really deliver over the longer term.
Absolutely. And just a reminder for everyone listening, the information we share today is purely for informational purposes.
It should absolutely not be considered financial advice.
Always.
Always do your own thorough research and due diligence before making any investment decisions.
We do value your insights, though, so feel free to share your thoughts on ABM's quarter and outlook.
Yeah, the question really remains, doesn't it? As ABM repositions itself for this next phase of growth and efficiency, will these proactive plays in a market that's clearly shifting, will they translate into a sustained upward trajectory for shareholders? Something to think about.